I've been in crypto since 2012. I've made millions and I've lost millions. Now I focus on just one thing: stable, high-yield returns with minimal risk. No hype, just smart, capital-preserving strategies that beat the market week after week. I'm the stable lad. Let's get into it. A quick disclaimer before we move on. This video is for educational and entertainment purposes only. Nothing shared is financial advice. I am not a licensed advisor. Always do your own research and consult a professional before investing.
This is a recording and a bit of a deep dive into lending protocols in crypto. So one of the ways in which I earn money on my stablecoins is by lending my stablecoins out. And one of the amazing things that crypto sort of does is it gives the individual the power of being their own bank. And so I have my money and I can choose what to do with it. I can invest it and buy other things. I can swap it into other stuff. I can use it and lend it out. There's so many things that I can do. I can provide liquidity to a liquidity pool, and we'll go into all these kinds of things in future videos. But this video is specifically a deep dive in the options of lending and how you would lend your collateral, your crypto collateral, specifically your stable coins, in order to earn yield in crypto. And there is no better lending protocol than Aave. Aave, AAVE, is the sort of oldest OG in the crypto lending space, built on the Ethereum blockchain. In fact, it used to be called ETH when it first started, and they changed the name to Aave pretty early on, before DeFi summer. And Aave has been through it all, through all the ups and downs of DeFi summer, to the sort of complete implosion of the crypto space, through all the potential sort of hacks and sort of growth phases. And they've sort of made it through all of that as, again, still the best in class in terms of what they offer and what they do. As you can see here on this page, they've got 51.48 billion of liquidity currently supplied in Aave. You can supply assets, you can borrow assets, you can borrow against your own assets. And I use it specifically just to supply assets for the most case. I have borrowed before. I feel completely confident and totally safe borrowing from Aave. And the way it sort of works is on the supply side, you supply your collateral. If you were to borrow, depending on sort of the volatility of what you're borrowing against the collateral that you provided, there's a sort of health score. If you get underneath that score, it can be liquidated in order to cover your loan. But again, I'm going to focus mostly on the supply side of things, since I'm not talking about borrowing here in this video. I'm talking about supplying your stable coins to earn yield. So Aave is one of the largest DeFi protocols with billions of dollars in weekly volume across Ethereum and 12 plus networks. It says 14 here networks here, and we'll kind of go over what that is. But essentially, they're large, right? 51.48 billion, 332 billion of volume in the past 30 days. Their average stablecoin supply of their APY is 5% over the past year. Of Ethereum over the last year is 5%. This is what DeFi is, right? And it's really, really impressive. So if we're going to go to Aave, here we go, open the app. I already have the app open here. What we would do is we go to the dashboard and we take a look at the dashboard. And right here, right at the very top, you can see all the different sort of markets. Version 2 is sort of their older version where they had 3 different markets: Ethereum, Polygon, and Avalanche. Version 3 is a lot more options here. And these are, when they talk about having the sort of the networks and the marketplaces, this is what they're kind of talking about here. We've got Ethereum, we've got Coinbase's Base protocol, which is a layer 2 built on top of Ethereum. Arbitrum is another layer 2 built on top of Ethereum. Avalanche is a competing layer 1, and so forth and so on. You've got all these different options here, and I'll do future videos on layer 1s, layer 2s, what they are, the sort of pros and cons of working with either of those for people that don't know what that is. But for today's purposes, let's just look at the Ethereum blockchain. It's the sort of biggest, most robust blockchain, and we can kind of see what we got going on here. If you were to supply Ethereum, for example, which is a volatile asset, but if you were to supply Ethereum, you can earn 11.69% here, APY. So let's just say you're a long-term holder of Ethereum. You have no plans on moving it or doing anything with it. You can just post it up here, supply it, earn 11.69% on your Ethereum. There is some risk to it, but in all the years that I've been using Aave, I've never lost collateral personally. And again, I'll do some more deep dives on these protocols, especially what I consider grade A protocols. And Aave is one of the 4 grade A protocols that are in the blockchain now. There's not many that are grade A, in my opinion, from a risk perspective. Aave is one of those. They've stood the test of time. Now, if we could see here, if we kind of look down here a little bit, we can see here USDT. Right, USDT is the largest stablecoin in the world, still Tether. And if you just post your collateral here, you earn 3.29%. It's pretty low on the low side because these are such active markets. But again, this is a sort of like if you wanted to set it and forget it and not really worry about it, you can earn 3.29% on your stablecoin. If you take a look at more of these, you can see USDC is 3.9%. And you can kind of just scroll down and just see what the market looks like. USDS is here's DAI right here. DAI was issued by a protocol called Maker DAO, and Maker issued the first over-collateralized stablecoin. So it's got basically the treasury of the DAI stablecoin is a mix of other stablecoins and crypto assets like Ethereum, for example. USDS is their new rebranded version of DAI, and it's something that they're really quickly trying to grow, and they're paying even a higher percentage on, including this reward, which is a USDS additional reward in order to entice people to supply here on this chain. And again, you can kind of take a look here at the core instance. You can take a look at their prime here. Go is Aave's own stablecoin, so Aave issues their own stablecoin. This is the Go stablecoin. They're paying 3.74%. Here on this market, they're paying 4.66% for USDS. They're paying 4.1 in this market for USDC. Again, if you wanted to just sort of set it and forget it and just earn kind of the same amount you'd be earning from a bank and just diversify out a little bit, this is a really cool marketplace for you to earn that. As markets tend to sort of grow, these APYs can come up. So as the market heats up and borrowing becomes more and more prevalent, these APYs can increase. And so in a bull market, you can see numbers jump up a lot. Here on the Base blockchain, we just looked at here at Base, we're paying 4.5%. Now we're getting kind of like above what banks are paying at this point here. For the Go token, you're paying 4.89% on the Base blockchain. It's pretty good. Let's take a look at just kind of one more on the Arbitrum blockchain. Again, this is a layer 2 on Ethereum. Let's kind of take a look. 4.3% on USDT. And you can see here USDS is paying 4.5%. So again, these are pretty good active marketplaces. I don't use Aave a ton because it's such a big, robust marketplace. It tends to be on the lower side of the APY options out there. However, it is, like I said, a grade A protocol for me from a risk perspective. And I generally have at least some assets sitting in Aave. It's just, again, a sort of like, I can set it, I can sleep. I know I'm making only 4.5%, 5% on some of these things, but I don't have to think about it or care about it. So it's a small percentage of my portfolio. I keep it over here and I don't have to think about it whatsoever. Oftentimes too, you'll find additional things. There are additional ways, like there are rewards for using the Go stablecoin. Sometimes they provide additional rewards. Sometimes they don't. But here you can see here's 4.3%, and then you can see it's variable right here. Like it can get much higher than that 4%. So anyway, that's the Aave blockchain. Here we're going to take a look at the Fluid blockchain, or the Fluid protocol, excuse me. The Fluid protocol is another DeFi lending protocol. It's newer, and so because it's newer, it's still I would consider it a grade B. It's newer, but it's got a lot of volume on it. It is a solid lending protocol. We could just take a look at here. We're at like what, 2 bill. Right, so we've got tons of assets sitting on the Fluid blockchain, on the Fluid protocol, excuse me. keep saying that. And then if we go to lend here, we can kind of see our markets. So here they have a little bit of different. They don't have 14 markets because they're newer. They've chosen to start with 4 major markets for them that they want to grow: Ethereum, Arbitrum, Base, and Polygon. These are all Ethereum-based marketplaces. So if we want to go to Ethereum here, we'll see here, if we supply USDC, we're earning 7.12%. That is phenomenal, right? I mean, that's just great. You're just sitting there posting up your USDC, your stable coin, which is sticking in value, and you're earning 7.12%. Here, if you post Aave's Go and use that as collateral, you're earning 8.36%. It's phenomenal. Again, just to sort of set it and forget it. I wouldn't put all my assets here because it's a newer protocol. It's not as battle tested as Aave. And I've done deep dives before on kind of portfolio structure, and I'll do further videos on how I do structure my portfolio using the Half-Kelly criterion and a modern portfolio theory. But this is just sort of one lending protocol that I would use. But if we take a look here, let's take a look. We'll just hover over this icon here. You can see here that the Go APR is 8.3% total. Go lending APR is 4.33%, and the Fluid rewards is 4%. So what Fluid is doing here is Fluid has their own token, and they're incentivizing users to put money into their protocol. They're trying to grow their protocol, the Fluid protocol, and they're enticing people. Aave did the same thing when it first came out. Now it's much more robust. They don't do that anymore. They've figured out other ways to entice people to keep using Aave. Fluid, because they're just they're fairly new, they're like a year or 2 years old, they're enticing people using their own token. Their own token will be inflationary because they're issuing it and giving it away for people that supply value and collateral. So that token is going to be inflationary, and it is going to be volatile. It'll go up and down. So when I personally, if I sort of which I do have some money in Fluid, whenever I get these rewards, I sell them almost immediately, and I just buy more of the stablecoin asset because I don't want to sit there and hold it, hoping that the value goes up and then crying when it goes down. I just sell it right away. I don't even care what the value's at. I buy more USDC with it, or Go, whatever stablecoin I'm using. So even if my APR ends up being 7.5% or even 9% because the value of the Fluid token goes up or down, I'm still just going back to my stable coins. And then you can see here which sort of chains are paying higher amounts. Here, USDC is paying 8.3%, right? And again, we're seeing, look, USDC is making 5%. That's the base APR. That's pretty darn good. And then Fluid's paying, almost 4% on top of that. Again, pretty solid. We can take a look at the base blockchain here. Again, we're seeing kind of similar things here. Look, this is USDS. So this is staked USDS, which is a whole another thing. I'll go into it in later videos. And then Polygon's an interesting one because Polygon itself is a layer 2 blockchain on Ethereum, and they've got tons of money, tons of investment, and they're using their own token to incentivize these. So Fluid is not incentivizing these pools, Polygon is. So as you can see here, they've got actually a really small base APY of 0.5%. So 50 basis points is the APR for USDT, but then they're using wrapped Polygon token, paying 8.23% to incentivize this. I have put money into this before. Again, I just sell Polygon. Polygon is one of those ones too that actually moves up really fast in bull markets, but they move down really fast too. So again, a really volatile token, but nothing to shy away from. I take these rewards. Polygon's a super cheap blockchain to use. And so I take these rewards and I just sell them constantly, and I buy more of the stablecoin, the stable asset that I've used as collateral. So that's the Fluid protocol. P-Pods, and I just want to show you this just because there's tons of lending protocols out there. There's all of them, and they exist on many chains too, like Avalanche has its own, Solana has its own. And I focus mostly on Ethereum because I feel like those are where the sort of biggest blockchains are. But you can see here, these things are growing. Barachain, Sonic, these are kind of growing protocols. We've got here lending. Here's the lending stats on P-Pods. You've got 32 million In lending, TVL is total value locked, right? So total lending is almost 2 mil. Total borrowed 26, right? So these are really not small pools. PPODs is trying to grow, trying to compete, and so they're gonna offer really, really high yields. This is one of those things where I would put less of my portfolio in because it's so new, but I wouldn't shy away from it necessarily. And you can see right here, beta disclaimer, this platform is new, right? So all these features are in beta mode. I've done some research on PPODs myself. They have, you can take a look kind of here in the documentation side. They've done audits, so they've done a ton of risk, and they are doing all kinds of things to make sure that the protocol and the platform itself is sort of on the lower risk side, or as low risk as it can be, because they want to exist, right? I mean, if there's a hack, then PPODs is done; it's dead. So they're doing the best they can to kind of make sure that that these protocols stay really, really solid. But it's, again, just something that sort of be really, really sort of wary about. So here we go. Let's take a look at a sort of USDC. Let's take a look here. You can farm volatility here. You can lend a bunch of different assets. You can check a bunch of different chains here, and you'll see that you can supply things, and the APYs are pretty darn high there. So again, here you can see we went onto the base blockchain. They're paying 6.6% for this, but there's different types of a lot of these newer protocols. They do different things. They create like a fixed yield and a variable yield, and you can play around with these different things. And so different protocols are going to have different sort of rules on how they do lending and borrowing, and there's definitely opportunities to be made with higher yields on different blockchains. But I also want to bring up PPODs as another example. There's another protocol called Compound. Let's take a look at Compound Finance. Compound Finance is a massive protocol. Compound Finance, it's not even going to work now. And I'll explain. Oh, here it is. Compound Finance has billions in collateral across 17 markets. They were the first competitor to Aave in the space. So they've been around for a long time. And as of today, if I go and click into the app, it won't work. The website was hacked, and there is a massive phishing attack on the website. They're working on fixing it currently. But what it was doing was it was leading, if you clicked the app, it was leading to a website. And if you didn't look at the URL, it was leading to a completely different website and stealing user funds. And so again, it just sort of goes to show you that it doesn't matter how big or how small you are. You got to be wary, and you got to pay attention when you're using these newer platforms and protocols. You got to do your due diligence. You got to make sure the URLs match up. And you got to try to use protocols that are battle tested, and then even when they are, you still have to make sure that you're doing your due diligence. And so I'm going to do a future video that talks about my entire risk strategy and how I spread out my stablecoins over a mix of protocols and a mix of stablecoin assets themselves. And I do this so that if I lose money in any of these places, it doesn't wreck my entire portfolio. So even on stuff like Aave, for example, I don't put a ton of assets there. I spread them all out. If I'm investing 10,000 or 100,000, it doesn't really matter. I spread it out over a bunch of different things, and I'll do future videos that explain exactly how I do that. But this hopefully was a good primer for you to help you understand some of the lending markets, how they work, and then we'll get into future videos providing liquidity for decentralized exchanges and other ways that I make money utilizing DeFi and utilizing stablecoins.
I'm the Stable Lad, and if you liked today's video, please hit that subscribe button. Every week I break down what's happening in the world of stablecoins and why it matters, clearly, calmly, and without the hype. This channel is for educational purposes. It is not meant to be financial advice, so always do your own research and manage your risk wisely.